Hi there, Mr. Evans here. In this video I will be looking at specific financial objective about return on investment. So financial objectives to include the concept of a return on investment. I'm briefly going to have a look at that in this video here, and there's a couple of objectives for investment down there. So the types of financial objectives, okay, I've went over these I think in the this definition in the last video, but an investment objective is goals related to the amount to be invested in corporate development strategies, i.e. perhaps the purchasing of new equipment. So an objective might be invest 40% of last year's revenue into new capital equipment, okay, so that might be you're spending 40% of what you made in sales last year, maybe investing in a new computer system or new machinery that will make your product better, etc. So that would be a typical investment objective. So what factors determine investment levels? The amount of money that managers are prepared to invest in a company to enable them to achieve their objectives. So it might be better to just have a look at a definition first, and I'll come back to that slide. An investment we could consider to be expenditure by an organisation on resources that enable the business to achieve its objectives. So in other words, spending on things that will help the business to achieve its goals. Just to go through this, the factors that will determine investment levels include management attitude to risk. Are the managers encouraging of risk, or are they quite risk averse? They don't really want to put much money into new product development. If you want to see a business that is quite happy, the management attitude to risk seems to be quite open. Google are a company that spend a lot of money in investment, and you can have a look at some of the products that they have tried and they have failed with as well. Market conditions will determine investment levels, so what's expected to happen to the customers. Are they expected to be spending a lot? It might not be worth it if there are tough market conditions out there. Competitors' actions can have dictate investment levels. You might feel compelled to invest in new equipment if your competitors are doing so. The level of retained profit that an organisation has. The more retained profit an organisation has, the more ability it has to invest risk-free, because it doesn't have to borrow money or try and raise it from its owners by selling shares or anything like that. The rate of interest, or the availability of finance, I suppose to say, will also determine how much money businesses have to invest. And finally, the expected rate of return on an investment. How quickly will it take for an investment to be paid back? All of these will determine investment levels. So before a manager or any company will be prepared to invest, diligent companies, it's good practice to conduct something called investment appraisal, where managers compare the costs of an investment to the expected revenues it will accrue. So how can you calculate the return on an investment? Well, the formula is the total return on the investment, which is calculated by working out how much revenue has been gained as a result of the investment, and subtracting the cost of the investment. You divide that figure, you divide the return on investment by the total cost of investment, and times by 100. So that's the formula. Let's just work through an example to put it in context. So let's just say we earn £60,000 as a result of installing a new machine. The cost of that new machine is £50,000. Well, fairly obvious that the return on that investment is £10,000. So let's stick that in the formula. 10,000 divided by 50,000 times 100 equals 20%, and the return on that £50,000 investment is a £10,000 profit, which is 20% of 50,000. Now, of course, there are some difficulties in doing this. How do you know that the revenue, how have you calculated that machine has got you 60,000? The cost of the investment, is it completely tangible? Does that include the cost of training your staff, the cost of any delays, etc., as staff get used to the new machine? And this very simple calculation doesn't take into account any time. If a £50,000 investment earns me £10,000, but it's going to take 10 years to do so, then I'll probably be less inclined to do it. Nevertheless, you guys needed to be aware of return on investment as a financial objective. Businesses will obviously do this before an investment is made, and it allows them to set targets. If you calculate the return on investment is only going to be 10%, and it's a high risk investment, then that probably wouldn't be too appealing, and that's what investment appraisal is used for.